Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. During this segment, we're going to continue talking about the American Taxpayer Relief Act of 2012. We touched briefly in the last segment on the new 39.6% tax bracket. Doesn't affect a whole lot of people, we moved on. We're talking about the capital gains and dividend taxes. The capital gains and dividend tax remains at 0% for taxpayers in the 10 or 15% bracket. So that means that if you make up to $36,250 for singles or $72,500 for joint filers, you are eligible for your dividends and capital gains to be still taxed at 0%. And that's a huge, huge benefit. We saw in the stock markets, dividend stocks and some things that pay dividends took quite a leap after this was signed. They'd been hammered quite a bit in December, people fearful that the rates were going to go up. This is a great thing for investors. Essentially, you can have tax-free income from a regular brokerage account on long-term capital gains and dividends if you're in those lower brackets. If you're above the 15% tax bracket but below the 39.6%, your long-term capital gains rate remains at 15%. So only people that have taxable income above $450,000 or $400,000 single will see their capital gains and dividend tax go up to 20%. Now remember though, and this is where it drives me crazy with the tax code, is that they pass these things and it just, each layer upon layer upon layer becomes more and more confusing. Starting in January of 2013, this has nothing to do with the fiscal cliff. This was passed as part of the Obamacare Act a couple years ago. It was January 1st, 2013. There's a new 3.8% Medicare tax on investment income. And this applies if your income is greater than $250,000. You add another 3.8% to all types of investment income, capital gains, dividends, rental real estate, all types of income. And so what that does is it effectively makes the tax rate for people above $250,000, your capital gains rate is 18.8%, and if you're in the highest tax bracket, it makes it 23.8%, because you've got that extra 3.8% tax. So that's something not to figure out. A couple of other things that were brought back. The AMT was permanently fixed, and this is good news. Well, I just assume they get rid of the whole AMT, but short of that, at least they indexed the amount for inflation permanently. So no longer do every year, year after year, we have this issue of are they going to extend the AMT. So the AMT patch is fixed. It sets the exemption level at, it's going to be around $80,000 for a couple in 2012. Okay, a couple of things that other income levels, and this is with the tax code. In fact, just yesterday I had to go to take a test, the IRS, this new registered tax return preparer test, and the myriad of different levels and different things in the tax code is just ridiculous. And so already we've talked about people making $450,000, that's single and married, and then we looked at the new Medicare tax, which is for $250,000 married, filing jointly, single rates. Now we look at what's called the P's limitation, and this is where you start to lose part of your itemized deductions. I won't go into all the details, but essentially above a certain income threshold, you start to lose some of your itemized deductions. And for this one, they picked the level of $300,000 for married couples and for $250,000 for single people. So there's another income level you have to think about. The personal exemption phase out was also revived in this new tax law, and what that means is that if your income, once again, above $250,000 single, $300,000 married, you're going to start to lose your personal exemption again. It's going to start to phase out. So within all these different provisions that were passed, they're adding different income thresholds in addition to some that are already there. You know, child tax credit phases out, education credits phase out, IRA deductions phase out. So there's all these type of things that phase out. So for every rule, the way I describe it to clients is there are actually 3 different tax codes. There's one tax code, if you don't make anything, you actually get money back. Things like the earned income credit, these refundable credits. At the other end of the scale, you know, if you make a lot of money and it's, you know, some of these things start to phase out, you know, at $50,000, $75,000, you know, the capital gains rate starts to phase out at 75. So most of them, you know, somewhere between 50,000 on up to 450,000, these things start to phase out. So that's the other tax code. So there's very few people in the middle, you know, that between making absolutely nothing and making a living wage that all these rules apply to. And that's the great disgrace of our tax code, is that the rules that are written because of phase outs and exemptions and things like that, there are very few people that the sort of headline tax law applies to. And that's what makes it so complicated. It makes what makes it easier to game the system. And I say game the system, I mean follow the rules as they're written in a legal way to minimize your tax, because it's so complicated and the rules that are written apply to so few people. Okay, we're running out of time here. I want to get on a couple more things with the act that was just passed. Estate tax. This is very important. The estate tax was scheduled to drop back down to $1 million. Well, the $5 million limit, inflation adjusted, which is actually 5.125, was extended as permanent. They did raise the rate a little bit from 35% up to 40% for people dying after 2012, and this is a great improvement. It also continues the gift tax under the same provisions, and more importantly, it continues the prospect of what's called portability. And what that means is that if your spouse died and your will did not incorporate provisions to use your unused credit, is that under portability rules, the spouse could still get it. So as a couple, you could exclude more than $10 million. Under the old rules, the first spouse to die had to have some specific language written in the will, otherwise you lost that spouse's exemption. And that was just a terrible piece of legislation. Okay, well, we're coming to the end of this segment. If you've got any other questions on that, feel free to give us a call or email. Maybe we'll cover some more again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.